Hello everybody, welcome to another update on the stock forecaster. Today we are going to talk about Gran Colombia Gold. We know that gold is in a bull market, so we need to find the best gold miners out there, and I think this is the best one. A very good value. It has been going down, so this is a perfect time to buy it because they came up with new earnings and they were very good. So the first quarter earnings, as you can see here, production numbers are here, 200,000, so they are not impacted by COVID. Production is very steady. They are drilling for more resources. So they also had the technical report, which said that they had about 3 years of mine life. But of course, that doesn't count in the inferred resources and also the new drilling that will be coming on. So I think this is easily a 10-year mine life based on the resources that they have. So we would not worry about that technical report. We also see that revenues were pretty stable. AISC has gone down because it was 1,266 last quarter, and this is now much better. So that will give us more earnings, better margins. EBITDA is about the same as last year, but this is very high compared to the market cap. It's about 200 million EBITDA, and the company is about 250 million. So that's almost 1 times EBITDA. So this is very cheap. Cash, yeah, they have been adding cash. Free cash flow is about, you can see here, 15 million, so 60 million free cash flow. So that's 4 times free cash flow, very cheap. Balance sheet has 70 million cash. 70 million cash on 250 million market cap. That's a lot of cash. Net income was 118, very good. But of course there were some accounting changes here. They also sold some projects. The Zancudo project has been sold for 9 million. So the real net income is about, I think, 20 million. It's about 20 million, like last year. So per year they will probably have 100 million in earnings. So that's a PE of 3. So that's very cheap. You can see here adjusted net income was 20 million. So, okay, they will get 100 million in earnings per year. We are going to look at the balance sheet later on and see what they have been doing. Okay, so let's do that. So basically this is a 250 million company, US. And the thing about this company is that they have been paying down their debt. Let's take a look at the balance sheet here. So this was the balance sheet from last quarter. You see they had 450 million liabilities, and that has all been paid off, almost in half. We now have 202 million liabilities. So let's update this. 202 million liabilities. So they've paid down like more than 200 million in debt. That's gone from the cash here, of course. So they have less cash. The equity has gone from 200 million to 270 million. So that's a huge increase. You also see here that investments have gone up here. So that's Aris Gold. They have 44% of Aris Gold. which has the Marmato project, and this is fully financed. We'll talk about that. Production is going to increase there and costs will go down. So this investment here will probably go up in value. So it's very good. Let's take a look at some other metrics. Price to book value is below book value. So we have 250 million market cap and the equity is now almost 280 million market cap. So we are trading below book value. So this company cannot go down. It's impossible to go down. PE, as I said, was 3. Equity 276, below book value. A lot of cash compared to market cap. Price to EBITDA is about below 2, so that's very good. And the AIRC is manageable. Let's take a look at production. Production is very steady. I think this will continue to be very steady in the next years. And that's about 200,000 ounces of gold per annum. That's a lot for a company with 250 million market cap. So I think this is very undervalued. What can I say more? They have 44% interest in the Aris Gold. So Aris Gold is now developing this ore body. And in about 2 years, they will reach the lower mine, which is a very high grade, a lot of resources. You can see here that the production will be going up in 2024 when they reach the ore body. And then the costs will go down. So that's this investment here, this 183 here, 183 million, which will probably go up in value in the coming years. Let's take a look at the financials also. So this is my EBITDA times 5 valuation based on the current gold price. And this is the market cap. My valuation with 5 times EBITDA says that Segovia on its own is normally worth $750 million based on production that they have and the all-in sustaining costs of 1,120. So this is on itself already a double. And I'm not even taking into account the Aris Gold, which they have 44% of. So this is very, very undervalued. Let's take a look at the financials. We have increasing revenue. Increasing equity. Revenue is stable. But it's good that we see that the equity is going up. So there is return on equity with this company. So you will go to see this company go higher and higher. Net earnings were very good. They have sold some projects. Operating profit is stable. And net earnings will probably be around 20 million per quarter. So 100 million per year if the gold price goes higher. 100 million net earnings with a market cap of 250 million. Just let that sink in. Okay. Now, they also announced the acquisition of GoldX for about a few $100 million in shares. Let's take a look at that. So I have looked at the NPV of this project. It has an NPV of about 1,300 at current gold prices. It has a mine life of 24. AIC is very good, below the 1,000, so that's a good project. Mine life is very long, so let's divide it by 3. to get a current value of that. So the NPV would be 1,300 divided by 3 is about 450 million. So that's the true value of Goldex, 400 million. And they have bought it for about 200 million or 250 million, I think, because they had a premium on the market cap of 200, about 30-40% premium. So let's say that it's bought for 250 million and then the real value is 450 million. So they have bought this company at a very good price. It will give a lot of leverage to the gold price. So let's say that gold goes to 2,300 in a few years. That would go here. And then we have about 2 billion in NPV divided by 3 is 700 million. So if the gold price goes higher, then this will be a lot of leverage for Gran Colombia. And the capex is pretty high, okay, but the CEO has said that he could bring this property into production with a lower capex, with a smaller plant. So they will start it out. It will probably be very profitable in the coming years. There's a lot of resources. Look at this, 10 million ounces of gold. That's a lot of gold. If you value that with the metric of $30 per ounce, then you would have 300 million of value in the ground. So 300 million of gold in the ground with a 200 million market cap. So that is a very good acquisition because they have that much of gold in the ground. It is fully permitted. It can readily be started up. They just need the money to get this in production. So that's a good acquisition. We have good acquisitions. We have a good asset, Segovia, which has a 10-year mine life probably. And they have 44% of Aris Gold, which will increase production in a few years from now. Costs will go down. The equity will go higher. This investment here will go higher. And we are below book value at 0.9. So I have been acquiring this hand over fist. And this is not financial advice, but do your own due diligence and take a look at this company. I'll see you in the next video. Bye.